Hello there, everybody, and welcome to this Hardman Co Investor Forum. For those who don't know me, my name is Keith Hiscock, and I'm the CEO of Hardman Co. Now, we've held forums for more than 6 years now, giving investors the chance to hear a company's investment case and question the management. But although we've held many forums in the past, this will be our first virtual one. And so inevitably there are a few practical differences. So first of all, you will find that your microphones and cameras for attendees have been muted. That means that we don't get any feedback noise and enables us to focus on the speaker. If you'd like to ask a question, you'll find at the bottom of your screen, your Zoom screen, a button called Q&A. Please click on that, post your question there, but please make sure you start with the name of the company at which the question is directed. My colleague Richard Angus will be in charge of the question section for each company. Now, we may not have time to answer every question in the time allocated, and we may combine questions if they're broadly similar. But if we run out of time for all your questions to be answered, or if you think of further ones during the forum after the speaker, the session is closed for that particular company, then just ask them in the Q&A. But again, remember to start with the company's name. And should there not be sufficient time, should there be sufficient interest and a sufficient number of questions, we would plan to have a further interview with the company posted at a later date to answer those questions. Now, also during the event, we'll be holding polls about each company. When we do so, a poll will click up on your screen. There's going to be more than one question about each company. So please scroll down to answer them. There's a scroll bar on the right-hand side you pull down, and then you have to press submit. These results will be passed on to the companies, and your feedback is really very, very welcome. We welcome any other comments about the companies, either through the Q&A section, again, the name of the company, or afterwards by email to us. Now, we've got 4 companies presenting today. They each will have about 15 minutes for their presentation, and then 10 minutes of Q&A. You should all have received a 4-page note from our analysts on each of the companies. We've posted a link in the chat function here on Zoom, which will take you to the research notes directly. Then afterwards, we'll send you the notes again. Now, the first company presenting is Palace Capital. We're fortunate to have with us today Neil Sinclair, the CEO, and Stephen Sylvester, the Finance Director. Palace Capital are experts in regional property investment, and they aim to unlock value through better asset management to deliver attractive total returns to shareholders. Last week, I watched an interview that Neil gave to Sky TV just days before the general election last December, where he pointed out just how different conditions are in the north of England compared to London and the south. And we've obviously, since the general election, seen a rebalancing in government policy, we're only at the very beginning of that, towards the old, what were called red wall Labour seats. And Palace Capital is very directly exposed to that. And then earlier this week, the company announced a really pleasing set of final results. So without further ado, let's go to Neil. Neil, over to you.
Good afternoon, everybody. Thank you for joining us. This is a very momentous day for me because I had my hair cut an hour ago. So that I can tell you. So we are experts in regional property. We work on the basis of total return and we unlock value by doing that. So regional returns have outperformed London over the past 4 years. Our portfolio is mainly made up of offices, just under 50%. We've got about 14% in industrial, and offices is one of the strongest risk-adjusted sectors in the UK. The reason we invest in the regions is, one, there's been limited development. Secondly, there's been what's called permitted development, which is the loss of office space to residential. And thirdly, you've got the government's levelling up agenda where they're focusing on regenerating the Midlands and the North. And we feel we are well placed to take advantage of that. And already we're hearing about certain government departments that intend to move to the north of England. So this is our regional portfolio. We have 53 properties. We have 204 tenants. Our top 20 represent 42% of our portfolio. Our finance director, Stephen, will tell you that of our top 20 tenants, 19 are up to date with their rent. And a lot of our compatriots have been struggling with rent collection. We've had a very strong rent collection from March to June, and June to September is already looking particularly strong. We operate on three areas we call Core Plus, which is our property investment and our income. Then we have our development, and we'll talk about what's called Hudson Quarter in York in a minute. And 32.7% are properties which we buy where we can add value through refurbishment or redevelopment. So the Northern Powerhouse you've all heard of. We are very well placed with the Northern Powerhouse. We have significant holdings in Liverpool, Manchester, Leeds, Newcastle. We're building in York. Up until last Friday, we had an investment in Sheffield, but we actually sold that. We're great believers in recycling our money, but we're very well placed in the north of England. You probably know, besides HS2, they are planning a high-speed rail between Manchester and Leeds. So how do we deliver value? So Hudson Quarter is what we've called our development, which is situated approximately 1 minute's walk from York Station. This was a 100,000 square foot old British Rail office building, 80% empty when we bought it. We bought it from Quintain. It was valued in 2013 at 3.8 million. We went through the planning process, and by September 17, we achieved the planning consent that we wanted, and it was valued at 16 million. This is how we create our value. We then had to take a decision. Do we sell it or do we do it? And we took the view the right thing to do was to really make money here, was to develop it. And we estimate that our gross development value from this development will achieve at least a 10 million surplus and a 20 million pound cash on cash return. It's fully funded by Barclays Bank. We've already sold 32 apartments valued at 8.5 million. 5 were under offer when we presented this presentation. We've agreed 2 more for $500,000 in the last 48 hours. The marketing is going full speed at the moment. It was very quiet, to be quite frank, until about 2 weeks ago, but it's picked up very significantly, and even more so yesterday afternoon and this morning with the Chancellor's statement on stamp duty. We are very confident we are going to sell most of these by the time it's completed in March 21. And we've also got an office building there of 35,000 square feet of the highest quality. York has the fastest connection to the north from London in 1 hour and 50 minutes. And we are very confident that we will let that building. And we expect to complete this property in March of next year. One thing I would mention, there's been a lot of talk about the future of the office. We are very clear about that. We think the office has a future, but people will look at cost. And the great thing about regional offices is that the rents are modest compared to London. And we think in the next 2 or 3 years, both the public and private sector are going to look at their overhead, and they're able to go to York at £25 a foot instead of being in London at approaching £100 a foot. So we also create value by refurbishing buildings. This is what we call value add. This is the entrance in our building in Newcastle, which we bought for £20 million 3 years ago. The rents in those buildings, this building was just under £18 when we bought it. We're now getting over £21. We did a recent letting to the National Lottery, who are in there. We're refurbishing 2 floors, both the 3rd and the 7th. The great thing about Newcastle is what we're hearing is that this figures very much in the government's levelling up agenda. There are already requirements for Newcastle from the public sector. They're already getting round the corner to our building over £24 a foot. And on a new building, which the Legal and General are developing, they've agreed to let a good slug of that at £26 a foot to the government. So we think this particular building will show considerable growth. I'll now pass you over to Stephen.
Thanks, Neil. So if you're investing in real estate at this point in time, you'll be very aware that rent collection has become the #1 thing talked about. COVID-19 has brought to prominence rent collection. As Neil said, our rent collection has gone extremely well. March quarter, we've now collected 93%, and June quarter, which runs through to September, we're up to 84%. Clearly, that 16% that's uncollected and outstanding is it takes our attention, and we're still looking to bring that down. But in the circumstances, we are extremely pleased. We're well ahead of our peer group in terms of rent collection, and a lot of that really has been down to the way that we manage our properties. Although we outsource to managing agents, rent collection and facilities management, in this instance, we took it upon ourselves, and internally our asset managers spoke to every single tenant. We have 200 tenants across our portfolio, and although it's been painstaking, it's important that we actually understand what are the key drivers with our tenants. And as I say, we've come out in very well from these last 2 quarters. One of the reasons we've just announced our year-end results this week, and one of the reasons we delayed it a month was because we wanted our June rent collection stats before we reinstated dividends. Here's our financial track record. Clearly, the portfolio has grown over the last 5 years. We tend to gear our properties, and our comfort level is around 30 to 40%. That's the bracket that we tend to operate in. You'll notice loan to values increased to 38%, which is fine for now. We will look to see that reduce. And as Neil mentioned, Hudson Quarter, which is a major development for us in York, is due to complete next year. So we'll see that loan to value drop back down towards 30% off the back of that completion. I will just mention here, in terms of property return, we have outperformed the benchmark now for 3 years running. And although our return has fallen over the last couple of years, clearly it's market driven, but the important thing is how we perform relative to our peers. And as I say, we've outperformed our peer group. The chart to the right just shows our cumulative dividends paid. We have been paying at a rate of 4.75p per quarter up until COVID. And at that point, we decided to cancel our Q3 dividend, which was payable in April, in order to preserve our liquidity while we saw the crisis play out. And as I say, we waited for our rent collection, and off the back of very strong rent collection, we've reinstated our dividend. We're paying 2.5p out next month, and that will be a minimum level that we look to pay each quarter going forwards. Important just to note where we're at in terms of our share price. When we kicked off back in 2013, we were at 200p. You can see shareholder return has been positive right up until the point of COVID. Unfortunately, it's had a big impact on our share price, and the chart to the right will show you that we've been impacted more than the average within our sector. We obviously think that that the market has not fully understood our situation, and actually our results coming through this week will hopefully have given lots of comfort around where we're at as a business. So just in summary, our rent collection held up extremely well in response to COVID lockdown. We hold the right assets in the right locations, and we believe we're focused with office and industrial in the right sectors. We've got income reversion within our portfolio. We refurbish space, and we're looking to grow our income organically. We also have capital growth opportunities. We've got a major development in York where we expect to see £10 million development profit come to fruition next year. We've got a medium-term development pipeline. We are a REIT. We converted to REIT status last year, and it's already proven an efficient capital structure. So we're well established, we've got a platform, we have a portfolio which is focused on the regions, and we believe is in the right place to capitalise on the government levelling up agenda. And we've come out the other side in terms of our rent collection, and we believe that we are well placed for the future. Thank you very much.
So now we are going to go to questions. I've got a number of questions about specific locations, so I'm going to try, in the interest of time, to roll this into one basic question. There are three properties that have, or three assets that have come up for discussion. One is the residential-led development in Surrey, which I think is Weybridge.
Yes.
The next one is Manchester, and I'll ask you a specific question on Manchester in a minute. And then also we've had a question about what happened in Sheffield. So I'm going to start with Sheffield and then go backwards. Can you tell us more about the Sheffield disposal? What was the thought process behind the sale, and how do the proceeds compare to book value?
Right. So I'll answer the third part first. So the book, that property was part of a portfolio that we bought off Quintain 7 years ago. And you know, when you buy 24 properties, there's always a few which we call dogs that you get lumbered with. You know, is this part of buying company? And these were a group of little office buildings near the Meadowhall Shopping Centre. It was never going to go anywhere. It's never shown any growth. And slowly but surely, we've sold off the buildings over the years. But we still had quite a bit left over. And last Friday, we sold it for £1.25 million. To somebody who actually agreed the deal on Monday and signed on Friday. The book value was 960. He offered £1.25 million. We wanted a little bit more. We said, well, we'll take that, but you've got to sign by Friday. And he did. And the good thing about that is it was not charged, so we get all the money. And we lose very limited income. Most of it was vacant. So that's one of the things we sold. The other two we asked about was Weybridge. Weybridge, we've got consent for 28 apartments. What we've done there is we've asked Savills, who are our agents on that, to give us a revised assessment as to the market post-COVID. They've initially told us that the market in Weybridge, because it's one of a very prosperous town, is still very strong. So we're looking at that, and we will make a decision probably in September as to whether we sell the site or whether we do it ourselves. One or the other, we're not sure. We don't have any money in it, it's uncharged. So all we've got to do is do the construction. That is all. And then finally, there was a question on Manchester, was there?
Yes, I'll give you the precise question on Manchester, if I may. If it's such a strong location, why do you not have higher rents per square foot? Maybe you could put that in context for people.
Right, so it's a good question. So Manchester is a very strong location, but this building is a 70s building, and it's not 20 years old. When we bought it, we were getting 12 to 13 pounds a foot. We took it as an opportunity for two reasons. One, it's got very good site coverage, and the building is 75,000 feet. Is not big enough for the site, frankly. It's got potential for at least 150,000 square feet on the site. But the space is what I call 70 space. We've refurbished it the best we can. And that type of space gets up to about 18, 19 pounds, which is what we're getting. But the fact is, when we bought it, the rents were 12 to 13. So we've actually seen a 50% growth in rent. And we've also seen a 50% growth in value.
Okay, I've now got a more shareholder-led question, which is what has happened to your shareholder register while the stock has dropped during the coronavirus? Have you seen much movement in the register, or is it basically a liquidity-driven fall?
I think liquidity is part of it, but the whole question with the shareholder register is that you have the shareholders listed on our website, but that's not the true situation, because they are the shareholdings as they've been disclosed to us. And as you know, if they don't disclose them to us, we can't technically say what they've got. But a number of our shareholders have increased their holding. AXA are over 10%. You probably saw last Friday that Allianz increased their holding and they're now over 5%. Unicorn have increased their holding and Henderson's have increased theirs. So most of our shareholders during this time have actually topped up their holding because they see the shares as good value.
Right, the next question is on LTV, so I'm going to combine two questions. You don't seem to have much headroom on LTV. How do you get around this? And what happens if values fall? If values fall, the LTV will obviously rise, but how do you address that whole equation?
Yeah, good question. The loan to value is certainly a covenant with the banks. I could have touched on this earlier, actually, that as a result of the challenges with rent collection, banks generally they have a cover test called interest cover ratio. Those tests have been under pressure at this time. Loan to values haven't been so much. I think the reality is if there is a downturn in the economy, your loan to values are then under more pressure. Now, we've always taken a view to keep loan to value at a conservative level. It is around 38% as we speak. And if values fell, then clearly loan to value would increase. I think that's where we've got, with York coming to completion next year, we've got a big chunk of cash coming in the door. Plus there's some disposals. We've got a disposal strategy where we're recycling some capital out of assets where we've maximized values. So yeah, it is absolutely, it's important to monitor that we do have headroom on. I mean, we've got loan to value covenants across our various facilities. We do have headroom, but it's always worth being very cautious when it comes to how far you gear your properties.
I think we should say, if I may very quickly, that if Hudson Quarter goes according to how we see it going at the moment, then we see the loan to value dropping into the low 30s.
So what percentage of the asking price are you getting on the apartment sales in Hudson Quarter?
100%.
100%. Okay. I've got two more general questions, and I think then we're almost going to be out of time. The next question relates to retail park footfall and your general comments as to what you're seeing and how quickly you think things might recover in terms of footfall.
Well, retail, we are seeing a slow recovery, but we're not a company that ideally invests in retail. We've acquired retail through the portfolio acquisitions we've made when the retail's been part of what we bought. Now, the good thing is that, for example, we've only got 2 retail warehouses, but we've got Booker as one tenant, which is Tesco, and the other one is Wickes and Pets at Home. So they've all been open all the time, number one. Wickes is in East Grinstead is one of their best performing ones, according to Travis Perkins. So in consequence, we're quite happy with those, and they've had reasonable footfall, even during the lockdown, funnily enough. But in terms of retail itself, we have very limited retail. We've got a supermarket let to Aldi, and that, of course, has been open ever since the lockdown. And the rest is all small shops. So we don't really focus in that particular sector. And even our rental collection figures on the retail side are really good at the moment.
Thank you very much. Well, I've got more than one question left, but in the interest of time, I'm going to ask you this final question. Are the directors topping up at these lower levels of stock price or not?
Very good question. That is definitely under review.
Thank you very much.
Let's now go to the second company that's presenting today, which is Phoenix Copper. Phoenix has an asset in the USA that covers 23 square kilometers, where it's focused on developing a base and precious metals mine. You might have noticed there's been a meteoric rise in the share price from 5 3/4 pennies in April to 29p today, just under 30 actually, which has reflected some pretty strong announcements in the last couple of months. We're very pleased to have joining us today Marcus Edwards-Jones, the Executive Chairman, and Ryan McDermott. If both of you gentlemen could turn your cameras on, and turn your microphones on as well. And Ryan is joining us from Idaho, by the way, just for some background for everybody. Gentlemen, the floor is yours.
Good afternoon. Good morning to those of you who might be listening from the United States. I'm Marcus Edwards Jones, and I became chairman of Phoenix Copper just as we IPO'd back in 2017 at 40p a share. And just before I go into the presentation, I'd just like to go through a few reasons why one would, when faced with a variety of sectors to invest in, why one would choose the mining sector, and indeed why one would choose a small company like Phoenix, which at the moment isn't making any profits or generating any cash, over a large company like Rio Tinto or Barrick Gold. The first thing is that I've been focusing on the mining sector for a while, on the basis that it's one of the few sectors where you're not going to get your lunch eaten by some new invention or some cutthroat company like Amazon coming along and destroying your retail business model, or Airbnb coming along and destroying your hotel chain, or somebody like sort of direct line insurer destroying your network of insurance brokerships, or a company like Netflix effectively ruining your pay-per-view TV model. One thing that the world is running out of is copper, and that's our main focus. And there are various statistics around, but an electric bus contains something like 814 pounds of copper. And I've seen various surveys which show that if all vehicles in the world were produced as electric ones, that would lead to a 22% increase in copper demand. And that's before you've looked at funding all the charging stations and associated infrastructure that has to go with copper. And the world is running out of copper, which can be mined at decent grades and low costs. And there are not many such projects going into production in the near future. And we're a 4.5-hour drive just up the road from the largest copper mine, in fact, the largest mine in North America, which is the Bingham Canyon Kennecott Mill near Salt Lake City, which has been in production since 1902. We're also involved in gold and silver, as we'll come to discuss. So if our punt on copper proves to be mistaken, and it certainly hasn't been the easiest to ride since we IPO'd, which is why our share price has been so weak, then we've got some optionality with our gold assets. And Paul Milcrease has done some great research on gold and its relationship with silver, which we'll also will come on to in a minute. But just to give you an illustration, if you ever go and visit the battleship Alabama, which was built in 1942 at a cost of $80 million, that was the equivalent at the 1942 gold price of around 2.25 million ounces of gold. If you multiply that by the current gold price, that's $4 billion. So that's quite a good example of how gold can protect you while governments are printing money. So the second reason, why would you not just invest in a company that was already producing copper, is that our market cap is only £18 million, even after the strong share price performance over the last few weeks. But if we manage to get into production, some of the modelling that we've been doing internally shows some really quite decent numbers, and our current contained metal in the measured, indicated, and inferred reserves we have is approaching well, it's north of $1.5 billion. So the upside, if we get it right, is really quite considerable. We're also on that sort of Rocky Mountain Andes axis, where there are just giant mineral deposits stretching from Chile up to Canada into the Yukon. We've got a very attractive position on the Idaho cobalt belt. Cobalt is currently selling for $28,500 a ton. Idaho is one of the few places in the world where cobalt has been mined in its own right. There's enough of it there to justify building a dedicated cobalt mine rather than mining it as a byproduct of copper or nickel. So we have that exposure to what is also an essential metal for producing batteries for the green energy revolution. But that's enough of that. I think we'll just now go into the presentation, which I'm going to load up, if I can do that. Here we are. So, disclaimer, and we're developing. We own currently 80% of the Empire Mine District, and we've been doing. We've all done exploration and production in lots of different places, and a good place to start is somewhere that was mined, where there's already been mining. We've got since we IPO'd, we've added substantially to the property, and we've got 5.5 kilometers of polymetallic strike length of mineralization at Empire, which has got several metals in it. Copper, you can see down there, we've got 130,000 tons of measured, indicated, and inferred. That's currently worth, the current crop is $819 million. Gold, we've got 343,000 ounces. That's worth currently $622 million at the current gold price. And the silver is worth getting on for 190 million at the current price. I was talking earlier about the optionality of the project, and we've currently got two prospects for early cash flow. We don't want to make the mistake that a lot of companies do, where they get into production, but the long-suffering shareholders, particularly the ones who took the biggest risk by investing in at the beginning, have ended up with a very minuscule percentage of the shares. I'm thinking of one of our neighbors, Nevada Copper, which, if you look at their share register, is owned mainly by finance providers, and the same with Sol Gold, which is a colossal project being to be developed in Ecuador. It'll be a huge copper mine when it's eventually built. But the people who put up the money to start it all off have got a very small amount of skin in the game. So we've got Red Star Silver and the copper gold silver open pit project, which are both in a race to be the first of the two projects we currently envisage generating cash from in late 2021 in order to fund the much bigger, the exploration of the much larger asset we've got underneath, which is basically a giant copper molybdenum porphyry, which we believe has been is the source of all the mineral deposits in our area. Which, by the way, includes 6 kilometers of gold strike at Navarre Creek, which we're also exploring. Here's our drilling program. As Ryan will tell you in a minute, we've got drilling activity at Red Star on the silver lead deposit, going on all through the summer, metals, channel sampling and metal processing. So there'll be lots of news flow coming from that. We'll have a resource update. We hope to have some kind of resource update on Red Star, maybe end of Q3, Q4. And on the Empire pit, one of the reasons why we've been doing well is we had a major result on the metallurgical test work where we recovered gold. We've got 97% recovery on our gold in less than 6 hours using ammonium thiosulfate, which is much more environmentally friendly and therefore much easier to permit than cyanide. So we're very excited about that. So we immediately moved a drill up there, and that's being drilled, and samples are going off to the lab and being both tested for grade and for gold recovery. Highlights. So we're basically targeting projects that can be brought into production with modest capex requirements. So we would hope to put a silver mine into production for something less than sort of $35 million all in. We think we can do that mainly with debt or streaming rather than heavily dilutive issues of more shares to our long-suffering shareholders. We're in Idaho. We've all worked in some pretty exciting places, but we felt that this opportunity was a much safer place to risk ours and our shareholders' money. Some corporate structure. We've got 62 million shares in issues, 10 million warrants and options, 11 million warrants and options, 73 million fully diluted. So our market cap at 30p fully diluted is getting on for £20 million. Shareholders, we're very lucky to have, although we're not technically an institutional stock, we're very lucky to have some very supportive long. Martin Hughes is a very, very close friend of mine, and Keith and Hiscock and Paul Bruce.
Marcus, can I just interrupt you there? The sound is just cutting in and out a bit.
Right.
I'd suggest you speak a bit closer to the microphone, into the microphone.
Okay.
I'll also remind you that we've got about another 15 minutes in total, including.
Yeah, I've nearly finished my bit. Yeah. Okay. So, Mark, you may have seen that during when our share price was down in wrist slashing territory at 10p, we managed to raise money at 15p a share, and that was Martin topping up his holdings. So we're very grateful to him for doing that. And we got some other very supportive long-term shareholders who we think will make it quite easy for us to continue funding this. Management buyers, I've already talked about on myself. Ryan is Idaho born and bred, and I'm going to hand over to him in a minute. And he has worked all over the world, including in Russia for Kinross, up north of Magadan. So he's quite glad to be back in Idaho. Ryan's grandfather actually worked on the mine at Mackay, at the Empire Mine, which closed in 1942 when all the miners were conscripted into the US military. not a hastily assembled bunch of promoters. Richard Wilkins, our finance director, I met him in Uzbekistan over 20 years ago, and I was an investor in Oxus Gold, which produced over 500,000 ounces of gold and 2 million ounces of silver in Uzbekistan. He also put in a mine into production with Roger Turner, who's further down there. And again, I've known Roger for 20 years, and they're very experienced, safe pair of hands. We've got a great team. Lenny Wilkes, head of our ESG program, she's also from Idaho and a very respected member of the local community. She's been very helpful to us. Dennis is taking care of investor relations, but he's also very good on the technical side. Andre and Jason. Jason is the representative of XGen on the board, who own the other 20%. Andre is very invaluable on legal and financial matters. We've got a great board, and I'm now going to hand over to Ryan to go through the projects in a bit more detail. Thank you all for listening.
Okay, can you hear me?
Yeah.
All right, thank you, Marcus. Let me load the presentation. Okay, as Marcus said,
This is slide 9 we were up to, Ryan.
yes. As Marcus said, we are located in Idaho. As you can see on the right-hand side of the screen there, our properties or claim blocks, all in Custer County and Lemhi County. Essentially, we started with what you can see in, I don't know if you can see my cursor, but the blue area is patented or private property, surrounded by unpatented claims, both in the Empire area and at Navarre Creek. A couple of key points there. What I pointed out in blue being private property, and that is where the core Empire copper, gold, and Red Star properties are located. Clear advantages to permitting when operating on private property in Idaho. In fact, we are exempt from NEPA, for instance, so long as we stay, keep activities on the private property. Let's talk about silver and lead. So the Red Star deposit is located about 300 meters northwest of the main Empire zone. And then another 1,000 meters to the west of that on the same trend is the historic White Knob, Bluebird, and Horseshoe mines. They all appear to be very similar in mineralogy, very similar in structural complexity, and we control all of that ground. Starting most importantly with Red Star, which we are currently drilling with diamond core HQ diameter. We're on hole 7 of a 20-hole program, and anxiously awaiting assays, as everybody is. There's a good picture. So on the left of the screen, that is the main Empire mine area. And you can see as you move to the right where Red Star is in association to the main Empire, and then the historic White Knob and Bluebird mine. So as you can see from that photograph, all of these projects, although they're separate projects, are within several kilometers of one another. And it's important to point out all of these projects are within a 10-minute drive from Mackey, where our office core shed is located. So it makes a very nice very nice, efficient day when we don't have to drive an hour to a project. We'll zoom this in here a little bit. So if you look in the center of your screen, the large red kidney-shaped feature, that is the Empire Oxide open pit, proposed open pit. You can see how it's situated on private property. Again, just north of that is the Red Star. The Red Star actually sits just inside the patented land. And then north of those projects are the White Knob, Horseshoe, Bluebird. You can see all of the hammer, hammer symbols. Those are former mines and prospects, and the blue lines are basically general structure and a description of how the mineralization occurs in this deposit. Here's a good photo of the Red Star vein. See the bounded by the red lines on the side. This is an andronite magnetite vein. It stands out very clearly in contact with the granite. This outcrop is the only outcrop that exists on the hill. Every other outcrop we make via road building. So it has been an exercise in road building and structural geology to figure out exactly what's happening with Red Star. As I mentioned before, we're planning a 20-hole diamond program, which is going on right now, with the intent to update the resource at the end of this year. Based on what we know from the surface, and of course it's just from the surface now, if this goes to underground, it'll be in the 450 to 500 ton a day production scenario. The information that we're gaining from Red Star, like I said before, is directly applicable, we believe, to the projects that we have to the north. So all of the geologic information, the mineralogic information, we're carrying on as we continue with exploration up and down the trend.
Ryan, sorry to hurry you along, but can I give you a 2-minute warning, please?
Oh, yes. Okay. Well, Red Star resource, inferred resource, 100,000 tons at about 16 ounces per ton equivalent. Let's jump into very quickly the main Empire mine resource, which we updated this year. Our modeler modeled each of the metals, copper, gold, zinc, silver, separately, and combined those models because we've found that each of those metals occur on a different trend. And the result is we increased the overall resource, 56% increase in gold, for instance, 13% increase in silver, 11% in copper. And we're looking at about 19.3 million metric tons of total resource as it currently stands. And then very quickly, if I have time, exciting piece of news. In the course of doing our regular metallurgical test work, our metallurgist was able to find a non-cyanide or a cyanide alternative reagent called ammonium thiosulfate. We ran some laboratory tests and it's showing 97% plus gold recovery, very low consumption rate over a very short period of time. We are continuing metallurgical testing, and will become more detailed as we move into a pilot test, and we'll certainly have additional news about that. Do we have time to take a couple of questions?
Yes, Richard, we'll start the questions, yeah.
Yes, we do have time for about 2 questions. I'm going to summarize this in not a question, but more of a comment. There's a lot of interest in the Red Star project, and obviously the updated information that you see, the news flow coming through in Q3, Q4, that seems to be of interest to a lot of people. I think you outlined what the capex might be, but I just to pass that point over. So I've got 2 questions that I've got time to ask you. The first one is, why do you think the market cap is so low, even after the recent rise, versus the large resources of copper, gold, and silver?
You want to handle that, Marcus?
Yes. Well, I think the problem was that the model that we originally had was based on doing an open pit copper mine and saving the gold and silver for later. And while it was the numbers were attractive, the way we wanted to do it was to really fund most of it as much as possible with debt. So that was we were unable to do that. But since we then discovered the Red Star outcrop and we remodeled it with the gold included, which wasn't included in the 2019 resource, well, not nearly as much of it. The story is where we've got much more optionality, and the market seems to have woken up a bit to that, but we're still below our 40p IPO price.
Okay, so I'm going to just ask a sort of associated question. That you mentioned that you wanted to avoid shareholder dilution if possible. How can you achieve this, and what are your longer term aspirations versus debt funding versus equity issuance?
Well, I think the sort of numbers we might see if the gold and silver prices stay where they are and the copper price recovers would mean that we would be able to pay back debt with quite an attractive interest rate and maybe a modest amount of convertibility or warrants attached to it in probably less than 3 years. So, and I think with interest rates where they are, and more people are looking for instruments like this in order to generate some income. So I don't think it will be as difficult as it might have been, say, 5 or 10 years ago.
Marcus, thank you very much. I've got one very specific question, then we're going to have to close. It relates to the lab pilot testing at Salt Lake City.
Yes.
And it would be good to have definitive timeline as opposed to a more vague answer, possibly, if you could possibly provide it.
We are currently shipping bulk samples to the lab. The laboratory anticipates that they'll have the larger pilot testing on all of the ore types within the pit completed in August to September timeframe.
Okay, thank you very much.
There's going to be a busy week next week. And did you mention the website photos, Ryan?
Oh, yes. Please, everyone, go to our website, phoenixcopperlimited.com. The photo gallery has photographs of the core that we've recovered from Red Star.
Gentlemen, thank you very much for your time. We will have to move on. We are going to have another poll. Again, it takes about a minute, please, to look at it. Please do scroll down. And the supplementary questions on Felix, we will basically deal with, as Keith mentioned earlier, in a separate session. Thank you very much.
And let's now go to Paul Bridge. So Civitas Social Housing has created one of the largest portfolios of care-based housing and healthcare facilities in the UK. It's been constructed through a series of 120 individual transactions, and the covenant and the income on these assets are particularly attractive to investors. It's got a market cap about £700 million, and we're fortunate today to have, as I say, Paul Bridge, who's both a founder and CEO of Civitas. Paul, over to you.
Good afternoon, everyone. I hope you can see the presentation on your screen. I've got a number of slides to present to you today, but don't worry, the number of slides in the pack doesn't represent how long my presentation will be. Some of those slides are just for information. A little bit about my background. As Marcus said, I'm the founder and chief executive of Civitas, along with 2 other founders, and my background is social and healthcare housing. A little introduction to Civitas. We are now the market leader dedicated to investing in care-based housing facilities in the UK. We IPO'd in November 2016 and have done 2 equity raises, raising over £650 million of equity. All our properties provide lifelong residences for people who are suffering from learning disabilities, autism or mental health issues. And the wider helicopter view to the British social housing system is that as we sit here today, around 4 million people are waiting for social homes. Obviously that need will never be met. And there's a desperate need for responsible institutional capital in this particular space. On page 4 and in the next few slides, we indicate some of the types of properties that we acquire. And we now have nearly 700 of these properties across the country. Each and every property is bespoke for residents living in them, and the life expectancy of residents living in these properties are likely to be as good as yours or mine. Turning to our rent roll is nearly at £50 million a year now, and you can see that we're paying dividends of around 5.3. The investment property at an IFRS valuation is now at nearly 900 million as of March 20, and our LTV level is at 27%. Some highlights about Civitas and the market and the portfolio. As I said, we believe that we have got the largest portfolio of care-based housing for adults of working age in the UK. We're a leading strategic counterparty for many major sector participants, including local authorities, housing associations, care providers, and the NHS. And I'll describe later how resilient this portfolio has been to the COVID pandemic. Some graphs ahead of you on pages 9 onwards describe the 6% growth in our annualised net rent roll and our 41% increase in operating cash flows, 28% growth in EPRA earnings, and our 6% growth in our IFRS valuation. As you can see on this slide here, we've made dividends consistently throughout the lifespan of the organisation, and the target dividend for 2021 is at 5.4p. The dividend cover is now at 100% as of 31st of March 2020, and that was up from 87.4% before that. Some operational highlights around Civitas, what we've done in the last year. Although this is social housing, providing housing for those with care needs, what's absolutely critical is that you understand the care that is going on in the buildings. That's not to say that we're operationally responsible for the care, because we're not. That's provided by professional care providers. But we now have extensive relationship with care providers across the UK, which gives us a sector and market leading advantage in both acquiring quality portfolios, but also in understanding that these properties are going to provide long-term accommodation. I'll touch on this more later. We've also been delivering some new state-of-the-art healthcare facilities, which I'll talk through shortly. We've established a social housing family CIC, partly to address some of the concerns raised by the regulator of social housing. And we've recently had shareholder consent to extend our mandate to work with new counterparties. In terms of our broader care provider relationships, as you can see in the graph on the right-hand side, we now have long-term strategic relationships with some of the largest healthcare providers in the UK. That's enabled us to back a third of the portfolio with 25-year back-to-back care provider leases, which gives additional protection to the housing associations, which also have back-to-back leases to us for 100% of our properties. The facility shown here is one of the state-of-the-art facilities I was mentioning earlier in Wales. This actually was commissioned and completed 2 weeks ago. We don't buy buildings, we don't take development risk on buildings, but we buy as exit. This is specified by the NHS and the local authority. It's a high quality 16-bed facility for mental health, autism and learning disability. And on the next page, at page 16, you've got a new facility that will come on the next few months, which is for 49 people. And you can see the bespoke nature of the facilities that have been provided there, which are simply some of the best facilities in the country. The Social Housing Family Community Interest Company, which we sponsored the setup of last year, it's chaired by myself, but it is independent from Civitas, both operationally and legally. The purpose of the CIC is to raise standards amongst housing associations in the sector, especially among specially supported living providers. It provides access to senior level management skills and resources, enables those housing associations to target the objectives set by the regulator, and enables in due course for CIC members to develop their own properties, thereby strengthening their balance sheets and growing their reserves. The first housing association to join was Auckland Housing Association back last year, and since then there have been a number of achievements that Auckland has been able to do in partnership with the Social Housing Family CIC, which include recruitment of several significant industry figures, both from housing and care, and also a number of new board members with significant financial and housing experience. They've also been able to safely increase their size from 500 homes to 800 homes. Turning to the widening relationship that we're developing with counterparties and regulators, the reason that we are shareholders to extend the mandate was because we've had extensive discussions with local authorities, with the NHS, with charities and other companies to extend the mandate and to provide housing through their management. If we're successful in signing some of those leases, it will mean that we have a plurality of regulation, and it means that the Charities Commission, the Care Quality Commission, the Financial Conduct Authority, and the regulator of social housing will all be regulators for some of those entities. And we felt it was important now to get that mandate changed, because obviously we won't be able to progress those conversations without having the permission of shareholders, which we've now achieved. The key characteristics of the Civitas portfolio: so 100% of the portfolio is let under long-term lease commitments. 2/3 of the portfolio is well-located community properties like the pictures I showed you earlier, and more than 1/3 of the portfolio is the higher acuity properties that I showed you in Wales, which comprise new purpose-built or repurposed properties. We have very limited uncovered voids. What we mean by uncovered voids is where the housing association is liable to pay for them. It's less than 3%. Care providers cover the void obligations of those housing associations. And we now house nearly 4,500 people with an average lease length remaining of 23.7 years. On the next slide, we look at our track record of successful capital deployment. And as mentioned in the introduction, we have carried out over 125 transactions. That sounds an enormous number. It certainly is. The reason for that is it's important every single building meets the needs of the local authority, is in the right geographic area, is of the right quality. And as we sit here today, there simply isn't large portfolios of these properties available, because many of them need to be brought on stream. And obviously that means that we now have potentially a portfolio effect over the nearly 700 buildings that we own. We've managed to achieve good yields of around 5.9%, which has contributed to our strong and consistent annualized rent roll growth. Importantly, in respect to capital deployment, it's obviously vital that robust due diligence is carried out. And as a consequence of that, we've rejected over 400 million of transactions. The primary reason for rejecting transactions is the level of rents, where properties are over-rented, or properties are in the wrong place, or the property condition is not good enough. What is absolutely fundamental, given that this income is 100% state-backed, is that we show that it's good value for money. So the rents that are being charged here are slightly higher than social housing rents, and that's been set in law over 2 decades ago. The reason that this rent regime was set up was because several decades ago, governments of all political persuasions decided that people with a learning disability, mental health or autism should not be living in institutions or in the NHS. Unfortunately, there are still people living in those conditions, which is what is creating the additional demand. In addition to the demand created by, thankfully, the improvement in life expectancy, is also better postnatal baby care in the last 3 decades, which has meant that increasingly a larger number of people are reaching adulthood and beyond, which simply wouldn't have done 30 years ago. So the Rent Standard 2020 confirms by the regulator that specially supported living is exempt. And because, as we've demonstrated, our properties tend to be mid and higher acuity, what we feel is that amply demonstrates that these rents are applicable and exempt. And we help our housing associations to demonstrate that to the regulator when they're engaging with the regulator. In respect to the pandemic, we've had no interruptions whatsoever in rents collected or rents paid. Our rent collection figures are just over 99.5%. All of the income is paid by the state. One of the reasons why the level of infection within the properties has been so low is, first of all, as I mentioned, the people living in the properties tend to be young, so they don't necessarily have physical underlying health conditions. They do have learning disabilities and mental health issues, but that doesn't affect their resistance to infection. Secondly, the nature of the care that's being carried out here is very distinct from elderly care. So in fact, the CQC, the regulator of care, produced some figures in the last few weeks that showed that the total number of deaths within all of specially supported living, which it probably comprises 150,000 people, has been in the low hundreds. Obviously that compares with, very sadly, with care homes, where the figures have been tens of thousands. And the reason for that is the one-to-one care that's been provided means that a care worker is dedicated to a particular building and often to a particular residence, often providing care that's over 40 or 50 hours a week. In addition, these care providers have been well supported by local authorities in terms of payments for additional PPE and other additional staff-related costs. And Civitas has been able to play its part in addressing homelessness through the pandemic. As you may be aware, the government in the UK ordered all local authorities to rehouse all rough sleepers immediately, overnight. The majority of that was carried out via hotel accommodation, but we were able to provide a newly refurbished block of flats to Islington Council, which will further add to our reputation, we believe, in the sector. What's absolutely fundamental to us and has always been at the heart of Civitas in terms of how we invest in this sector, because it is a social sector, is that we demonstrate very strong social impact. We test ourselves thoroughly on this independently once every 6 months with the assistance of the Good Economy Partnership. And in addition, in the last year, we brought on board the Social Profit Calculator, who aid governments in assessing the social value created by particular investments. And what it's shown is some substantial figures that actually directly the Civitas portfolio saves over £65 million a year to local and national governments. That's the differential between the cost of someone living in an institutional care setting or living in special supported living. And that 114 million of social value has been generated. And of course, both those figures increase as the portfolio increases. What social value is defined as is we did a sector leading with the Social Profit Calculator series of interviews with 150 people with learning disabilities and their families. And what that demonstrated is that there are many other additional costs that can be shown to be generated by moving into proper supported housing. To give one example, because many young adults were living hundreds of miles away from their parents or from their children and friends, travel costs are included in that figure. The most egregious example I came across recently was an 82-year-old woman who was having to fly from Belfast to Doncaster once a month to visit her son in hospital. He's now thankfully been relocated back in Belfast, but of course the costs of that were all met by the state. We've got a slide here about our financial industry and care sector awards. We merely highlight these to demonstrate that we believe we're right at the heart of healthcare housing in the UK. Now we were the largest single investor in healthcare UK housing in the last year. We've got a significant pipeline of opportunities coming up, and you can see an estimated value of 200 million there. And we're very well positioned for sustainable growth through our extensive relationships with care providers, taking higher acuity properties, working with the social housing family CIC to improve standards in the sector, working to expand our base in terms of working with different counterparties, and extending our geographic reach. So we now have a mandate to work in Scotland and Northern Ireland, and we are assessing opportunities in those areas at the moment. So finally, we believe we've created a robust and diversified mid to higher acuity portfolio to underpin long-term income and capital growth whilst delivering social impact and social value. So I will leave it there. Thank you.
Thank you very much indeed. I'm going to try to group these questions into, I think, 3 parts. The first set of questions are around the regulatory environment and issues with other parts of the market and how that impacts your opportunity. I'd then like to go on and talk about the size of the market, your market share, and how you scale your balance sheet, not in the next 2 or 3 years, but over the longer term. And then I have a question about the value of your shares. And the question basically, which you might like to start with, is, as the share price is more than the net asset value, how do you create value for shareholders?
Okay.
How much are you planning to raise the dividend going forward, and what other ways are you looking to increase shareholder value? So you might want to start with that one and then go back into the other 2 aspects, which are more structural.
Okay. Well, I mean, obviously some of this will be estimated, but as you saw in the presentation, the projected dividend for the coming year is 5.4p. In terms of additional value, where that potentially comes is in the aggregation value of this portfolio, because clearly with 125 transactions, the smallest being 300,000, I mean the largest being 80 million, you know, JLL do attribute an additional value through portfolio. We do tend to show IFRS now at the request of shareholders. I mean, the key purpose of this fund is to deliver long-term consistent income on a very safe basis with low levels of debt, and you know that actually it will be able to, you know, we call ourselves an evergreen fund. That's really important for the counterparties that we work with, because the need for this housing is lifelong and likely to be multi-decade. So what we're aiming for is providing consistent dividend and hopefully growth, but certainly consistent dividend payments, you know, throughout the life of the fund. I think you're on mute, Richard.
Would you like to address the regulatory environment, what was happening last year, and talk about the difficulty of trying to navigate your way through the regulatory environment going forward?
Yeah, so I mean, clearly all these housing associations are regulated by the regulator for social housing. They have one duty, which is to, I mean, obviously I can't speak on behalf of the regulator, but their one duty is to oversee standards in that sector. They don't have a locus for investment, and they don't have a locus for anything else in respect of the duties of those housing associations. Actually, some years ago, the regulator would have had a joint role, firstly to inspect standards, but secondly to promote investment. Those responsibilities are now split between Homes England, which is essentially the government's investor, and the regulator of social housing, which is essentially around standards. Now, the regulator of social housing has been quite clear that it absolutely sees there's enormous demand for this type of property. They've spoken to local authorities themselves, they've spoken to the CQC. It's absolutely clear that demand is very, very high. It's estimated that for every bed space we have, there are eight more people waiting for it. You can see in the wider material that we've provided that there have been a number of government statements and reaffirmations from all political parties of the need for specially supported living. And this is not unique to the UK, it's a Western European phenomenon. People have all agreed this needs to happen. What is quite clear is where the regulator is engaging with smaller housing associations. The average size of a housing association managing specially supported living is under 1,000 homes. And there's a simple reason for that, which is they've never received any government grants. and specially supported living has been only provided for the last 25 years. So they're all less than that. So when they become over 1,000 homes, the regulator will carry out an in-depth assessment and will make recommendations and will publish those recommendations for improvements to be made. Sometimes those recommendations that are made have already been implemented, and normally they're around operational and governance issues. There is to be absolutely candid, there's a wider point that the regulator has around the dependency of each housing association on state-backed income. You could argue that that is similar for other big general needs housing associations, except that they have the additional risk of development and of creating housing for sale to subsidise social housing. We personally have an excellent relationship with the regulator. We talk to them regularly. The Social Housing Family CIC that we set up talks to them regularly. We're not regulated by them. And we will diversify who we're working with. That was part of the purpose of the extension of the investor mandate by shareholders. So we will work with unregistered housing associations and other charities and other bodies to diversify some of the risk around that.
Okay, could you just expand on the practical benefits of having bespoke facilities? How much more efficient?
Well, in terms of bespoke facilities, so I mean, as you'll see from a lot of the pictures, in terms of the buildings that are in the community, they look like a building that any one of us might live in. It's inside the building where the bespoke nature takes place, you know, in terms of particular facilities, in terms of particular, you know, you might have heat sensors, you might have, you know, automatic lighting, you might have lighting that's appropriate for those people with autism, you might have sensory rooms, you know, a whole series of things. And a reason that those things are important is because when the local authority is specifying that they want Paul, say, to live in a particular property with a particular condition, those bespoke facilities need to be provided for Paul, because Paul is likely to be 25 years old and live there for 50 years. So it's absolutely critical that he gets the facilities that he needs.
There's a question here. Is your model applicable internationally? I'm sure you've got enough to do in the UK, but it was just a question that's just come in.
I think it is, yeah. And we've travelled a little bit in Europe, talking to people about what they're doing. As I said earlier, there is this type of housing in Germany and Scandinavia and various other European countries. So yes, absolutely, I think it is possible. There are, we've had discussions with care providers in Sweden who wanted to come into the UK. It's interesting because I hate to quote numbers like this because they may be inaccurate, but the care industry itself in this sector is remarkably disaggregated. So it's estimated there's 22,000 companies providing care. Some of that is obviously companies in different, you know, under different names, but at the end of the day, there's a lot of aggregation to come there. A lot of the bigger providers are starting to aggregate companies together, and there's a lot of interest internationally in that as well.
I've got a slightly technical question. What was the significance of emerging from the COVID-19 blanket material uncertainty clause that was mandated by RICS?
Well, that clause has been lifted now.
Oh, yes, it has been. But the significance to you is, what does it actually mean for investors? What does it mean in terms of the implications for you?
Well, at the time of the pandemic, there was no, I mean, with our independent valuers, JLL, there was no sense that there was going to be any effect on the valuation at all. And of course, as you know, and as we've demonstrated, there's been no operational interruption and there's been no loss of rental income. In some cases, that has actually got quicker because the state wants to make sure that it is paying its bills to keep people in the properties. But obviously, as you know, Richard, that material uncertainty clause has now been lifted.
Yeah, so I just wanted, for clarity, somebody was just asking that question. I've got a final question for you, which is, can you help me understand what the care provider gets out of the involvement in the equation between yourself, the housing association, and just put that into the are they able to make money? Are they solidly based?
Yeah.
That's really what we're asking, I think.
Yeah, no, it's a very good question. I mean, where this started really 25 years ago was that care providers, I mean, local authorities and the regulator at the time felt that having a care provider owning the building that you can see in front of you on the slide, plus managing it, created risks for people living there. The risks that people felt it created was that if the care started to fail, then the care provider could say, you know, even if the local authority and regulator intervened, the care provider could say, well, actually, we own this property and, you know, we're going to take our keys with us, you know, in the most extreme example. Secondly, the fees that we're talking about here are several £1,000s a week. They can go up to £5,000 a week. And even though that sounds very, very high, it's about 50% less than the cost of providing equivalent care in a large institution. And even if it wasn't significantly less, obviously the outcomes for residents are much better. We see a lot of media at the moment quite regularly about people, particularly young people, still stuck in institutions and in hospitals, and they need you know, high quality facilities like this. So the care providers also, many care providers own their own properties. Some of them are charitable, some of them are private entities. National Care Group that I mentioned earlier, that we work with a lot, are one of the largest privately owned care operators in the UK of specially supported housing. And in many cases, the newer care providers don't want to tie up capital in acquiring assets. They also, and where they do hold assets, they sometimes want to release that capital so they can expand their services, or to deal with the aggregation points so that they can acquire other companies. So if you look at Lifeways, Britain's biggest care provider, that's an amalgam of probably 40 companies that were bought over the last 20 years. And they were able to achieve that by obviously deleveraging and you know, and selling property and leasing it back. So the fees are very robust. Interestingly, if you take the building in front of you, the rent payable to us might be £200 a week per person, indexed, but the care fees, as I say, will start at £2,000 a week. So you can see there's a significant margin for the care provider.
Thank you. I've got one final question for you. Is Civitas planning to increase its scope to start investing in supported housing for individuals with lower support needs, victims of domestic violence, substance abuse, misuse, etc.?
Yeah, I mean, we already provide, some of the portfolio already provides accommodation for ex-offenders, for people who have had addictions, for people who require other support. And we do have, you know, we do have a couple of buildings where people have been fleeing domestic violence. Yes, so there's a range of different types of support that can be provided. Obviously, that needs to be provided by a professional care provider. I'm not going to say the accommodation's easy because it's really difficult, but even more important than the accommodation and getting that right is making sure that the long-term support for people moving in is there. Because if the support isn't there, then they're unlikely to thrive in the community homes that we're providing.
Paul, thank you very much indeed. I'm afraid we've run out of time. Ladies and gentlemen, we're going to have another poll. You've got about a minute. Please remember to scroll down, and then we'll continue with the next presentation. Thank you very much.
And let's move on to our final presentation today, which is coming from Open Orphan. This is a relatively newly created niche contract research organisation, which is a world leader in testing vaccines and antivirals through human challenge studies. It's been actively involved in the fight against COVID-19. We're fortunate today to have the founder, serial entrepreneur and executive chairman, Cathal Friel. Cathal, over to you.
Keith, thank you very much for the introduction, and thank you for everybody listening. And we've had a long afternoon. I'll try and keep it reasonably swift. Our disclaimer, as we all need to read from time to time. Look, I'm not going to dwell. We've a pretty tight management team. Our focus really is taking over smaller cap struggling in companies, putting them together, taking out the costs. Usually, being honest with you, we've taken over two, losing the money, the CEO and COOs, the very expensive people, and replacing them by the long-serving, harder working employees who've been there a long time, and that's what we've done. I'll come a bit more to that. Key attributes, what have we got? Basically, we've only put it together. It was a roll-up concept last year. We IPO'd in June, and we now have, in less than a year, we've created a niche CRO. What's a CRO? That's a contract research organization, or some people also call them clinical research. Basically, we perform the research on behalf, we test the drugs on behalf of the large pharma companies. We get paid regardless whether the drug's a success or failure. So we're consultants. We're growing, we expect to be profitable very soon. We have a high margin pharma services business, and the reason it's high margin, we're the market leader in an amazing niche. We are the market leader, we're the world leader in the testing of vaccines and antivirals, and that's an interesting space to be in the current world. We have a broad customer base, which includes global pharma companies, and basically every vaccine company in the world either currently is a customer or has been in the last couple of years. But really importantly, beyond vaccines, beyond COVID, we're building new revenue streams, which is very important because we don't want to be a one-trick pony. We're a substantial and growing pipeline. What's in the business? Look, being perfectly honest, we have two small businesses. Both were a mess. Both were losing millions. In the case of hVIVO, tens of millions. None of them are losing money today, and that's literally a year after Venn and 4 months after hVIVO. I'll explain how we do that in a minute. But the combination of the two of them, Venn provides pre-clinical service, that's before the drug goes into humans, and hVIVO is unique. It's Neil Wilford funded it. He put 113 million into it in the last 5 years, and we acquired it in January for 13. It has some fantastic assets. Of that 113 million he invested, a lot of it was wasted, but we did end up with a 24-bed quarantine clinic in East London. We ended up with a laboratory for 10 million, all replacement cost, and we ended up with a portfolio of 25 million pounds worth of challenge studies. These, we can't run our trials without them. But really importantly, if you look down at the screen, the bottom right-hand side, by the way, this presentation is up on our website, www.openorphan.com. Under investors, you'll find it there. We try and keep it up to date on a regular basis. But look at our Janssen, that's part of Johnson & Johnson, Boeing England, NIA, the American arm of the government, Gilead, Ipsen, even DARPA, the American Defense Research. So basically, anybody developing vaccines has been dealing with either Venn Life Sciences or hVIVO. We intend keeping these brand names, a family of companies. We don't believe in diminishing them. Our customers know hVIVO for 25, 30 years. It actually goes back, its history goes back to 1947. It was regionally known as RetroScreen, and before that, the Salisbury Flu Clinic. So it's unique in the world. It's been doing China, it's been testing vaccines going back to 1947 very successfully. A snapshot of what we have. I say we only IPO'd last year. We're probably one of the largest management team backed companies. I put over 2 million of my personal cash into it. And myself and the founders, we've over 20% of the company, and we're locked up for 3 years. So there's another 2 years to go before you'll see any of the founder team. Shares in issue. We have 640, market cap in recent days about 77 million. And very importantly, we have a lot of cash. We took over struggling companies. Our customers were frightened for years because they were so thinly balanced. So we raised money recently, primarily for 2 things: to bolster our balance sheet. When we're dealing with the likes of Pfizer, the Johnson & Johnsons, and the Gilead, big monster companies, it's nice of them to look at us now and say, wow, you've got 15 or 16 million cash in the bank. Revenue last year was 24 million. And we would expect it to do better than that going forward. And on a longer term, we have huge plans over the next 18 months. You'll see we have a pipeline of vastly increased sales. We have offices in London, Paris, and Breda in the Netherlands. There was 5 or 6 other offices. We shut them all. We IPO'd at 5.7p. We raised some additional money to fund the hVIVO acquisition in January, 6.1. And then being honest, that was a struggle. In January, the world didn't really know or want to know that hVIVO was a world leader in the testing of vaccines and antivirals. But funny enough, when we went to top up our funds at the end of May, we had one of the most oversubscribed fundraisers. We couldn't believe it. We went to raise 5 or 6, and it was many, multiple times oversubscribed. And we ended up getting purely institutional shareholders. We did make it open to our long-serving and long-following retail. We allocated $500,000 of that to primary bid. Unfortunately, we probably should have allocated more, but there was a lot of people looking for shares, but we're trying to keep everybody happy. Other large shareholders, Invesco 7.9, and they've assured us they're with us for the ride. Reason our share price came off, it ran up to about 16 in the middle of our fundraise, which was unusual. But once it completed, it steadied off at 16p. We had to raise it at a bit of a discount because the morning of the roadshow we started on the Friday, our share price is 11p, and naturally large institutions will not come in. They'll have no truck with us, but the share price bouncing 25% in the middle of the road. So we ended up having to do it at a discount, 11p. But even the share price today, we're still a little bit ahead of where that placing was done. Why did the share price drop off from 15 to 12p in recent weeks? Well, the Woodford stakes. There was 15 or 16 companies had a Woodford stake. Their name was down here up to 3 weeks ago. They had a 6% stake, and they all got bought by an American company called Acacia. Acacia bought all 14. In some cases, they dumped all of the stake. In our case, they dumped 2/3 of it. They didn't allow us to bid. Our institutions wanted to buy it, and they took an option of selling it through Berenberg, a market maker in London. And up until recent days, Berenberg were still selling some of that stake. We'd hope that overhang will be gone pretty soon. As soon as it's gone, I think you'll see our share price correct pretty significantly. What have we done since the merger? We've promised a lot, and I think we've done a lot, and we've an awful lot more to do in the coming weeks and months. We said we'd put the two businesses together. This is the end of January. We'd expand hVIVO laboratory services, and we'd convert the pipeline of contracts we get profitable. What have we done? We've completed all of the above. We've taken 2 million from the hVIVO cost base since January, 3 million from the Venn cost base, and a further 2+ million going on 3 by Christmas 2020. We expect to be, we're more or less there now, profitable. We've right-sized the management team. I say I have a habit of these companies getting rid of the CEO because I myself on a salary of 140, and believe it or not, some of the other CEOs we had were in many multiples of that. I think it's crazy. I'm not going to bore you with, we've been announcing deals, we've been doing a lot, and all I would say here in regards to the 3.2 million one, the 7 million pivotal study is coming down the track very quickly. So that's a 6th of March, 3.2, and then at 7 million. We also announced a 3.5 million in the May, and that will be now is actually in the clinic and work in progress. What I would say in the coming weeks, we've a few more in the 3 to 4 million territory. I know people would like to see us announcing one of these every week, every fortnight. Just bear in mind when we're signing off on 3 and 4 million deals, they do take a few weeks longer. They do take a little while. But all of these large multi-million deals we're doing, they're for delivery, the revenue for this year. They're not never into next year. Any of these deals, we'll have them completed, customer serviced, and money in the bank before Christmas. And we've launched our COVID testing. The COVID testing, there was a lot of excitement on it. There's a bit of confusion in the market about antibody testing, but what we've done now, we're doing both antibody testing and PCR testing. And what we're doing with our testing capability is building up a very strong business. We're approaching mid-size and large-size companies. We don't want a one-off big pop, do a lot of COVID testing, and then suddenly in 6 or 9 months it all disappears. We're building long-term relationships, nice profitable testing where we'll do both antibody testing, COVID, that's the antigen testing, and as we come into this winter, we have an ability to do influenza testing. We have a laboratory in East London. It's one of the few full virology laboratories in the Greater London area. And so we intend in that business to have a nice, sticky, steady business, not this mad big pop. So the antibody testing is shaping up really nicely. And there'll be more of that in the coming weeks and months. What is the big one, the story I want to tell everybody about, a challenge study. A challenge study is a way you test vaccines by challenging the immune system. We basically have a 24-bed laboratory. We're the only people in the world who announced we're going to do a COVID-19 challenge study. That's a clinical trial. And we're off to the races. That could fundamentally and massively will transform our business. As of today, there's 179 COVID-19 vaccines developed around the world. There's only 20 in the clinic. That's 20 who are going into humans as we speak. And of that, over 12 of them are in active discussions with us. We're guided the market. Those studies are about 8 to 10 million each. And we believe in the coming months, not years. By autumn time, we'd be surprised if we haven't announced at least 6 or 8 of this. So do the sum simple. 6 times 8 is 48. 8 times 10 is, so this could be big numbers. And they're for delivery in the coming 6 to 12 months. So it's a very exciting space to be in. We took a large chance, but it's actually really exciting. We have virtually every vaccine company in the world wanting, could they test our vaccine facilities? So we have to pick and choose, carefully pick them, and make sure the ones that we get maximum return on investment for shareholders. I'm not going to dwell on this for any who want to figure out that's how the challenge model works. Basically, we take 100 volunteers, they get paid 3,500 sterling. If they complete the trial, they come into our clinic, we vaccinate them a month before, and then we test them in our clinic. Does the vaccine work? By actually giving them a version of the disease. That could be influenza, RSV, asthma. In this case, we'll be giving them a version of, believe it or not, I know people think we're mad, but COVID-19 will be attenuated and it'll be reduced infection capability. So that's challenge study, page 9. And I'll take you now to page 10, which is our other services. So hVIVO laboratory services. The beauty about it, keep emphasizing, our business now, we have a very fast growing, steady clinical research organization doing challenge studies. They're very profitable, they're a niche, and we're one of 2 companies in the world that performs these clinical trials on vaccines. So that business is not dependent on COVID, but it's almost like an each way bet. We also have the COVID side, which is the COVID-19 challenge studies. We have a wonderful laboratory in the past, and we still need that laboratory for 10 to 15% of the time it's used to support our studies. Believe it or not, 80 and 90% of the time, no staff you're looking at in that laboratory do nothing. So we've now started laboratory services, and you noticed earlier this week, we announced 3 further deals. We announced 2 last month, and we're announcing lots in between. We're not even now getting around to bother to announce them, but that is a very sticky. We could get 7 or 8 million a year. It's about pure profit, those transactions. And the staff love it because it's interesting and exciting work. And most staff don't want to be twiddling their thumbs for 80% of the time. So that's the lab services business. Easily we're targeting 5 to 10 million annualized revenue, and we're well down the track in that. The quotient antibody, I think we covered that. It's going to be a nice steady. It's not going to be this big, massive, big pop and then pop down. So we want to build that steady, and we want to use all of that laboratory service testing capability, and we'll update you more in the coming weeks and months on that. The genomic database, it's absolutely, again, hVIVO, as some of the shareholders says, it was almost like a little gold mine that keeps on giving. Our genomic database is up and running, but more importantly, we're going to populate it extensively. hVIVO has the world's largest database and a lot of its genomic of infectious disease progression. They own the placebo side of all their clinical trials, and that's how an infectious disease passes through the body. This business has grown so nicely, we could almost spin it off to a standalone business zone. That's our genomic health business. You'll see and hear plenty more of that in the coming weeks and months. This slide is very important. Why both businesses lost money, then and hVIVO. Simply, their break-even point was too high. They had far too many offices, too high a rent, and really importantly, too many high-paid staff and not enough revenue. If you know, we've lost CEOs, more than one, i.e. we let them go, not they didn't leave us. And then we brought down the break-even point. And more importantly, we're bumping up the revenue very significantly. I'd say in the coming weeks, we've got a few more large contracts we want to be announcing. And as and when they come, we will announce them. If people bear with us, you'll see them. And then as we get into the end of the summer, I think you'll see sensational updates as regards to COVID-19 challenge studies. We are the only party in the world helping companies to test it in the form of challenge study, which means instead of taking 2-3 years to test a vaccine, we can test any COVID-19 vaccine 2 to 3 months in our clinic. It does take 6 months to get it up and running. We only announced 2 months ago we're doing it, so we should be ready on or before Christmas to start those clinical trials. Current trading is pretty good. The traditional ven business, now we're cracking the whip. We've been focused on the biometry, the data monitoring, and it fits into hVIVO. So it's providing really, really well. We've got rid of all the loss-making aspects of it. So the 2 businesses, hVIVO and ven, now are fitting rather nicely together. Our pipeline, dark blue, is the non-COVID, and keep emphasizing, even COVID disappeared tomorrow, and no, we'd all hope it would just go away. We have a pipeline of over 100 million of prospects we're working through over the coming 12 or 18 months. The light blue at the bottom, that is the COVID-related work. And there you have a pipeline now of 60 million at least we're targeting in the coming year to 18 months. We had it light blue because it was blue sky. That blue sky is becoming much clearer, and the COVID work is materializing because at the very end, we are now rolling out. We are doing antibody testing and we're doing PCR testing. So that's happening. Third-party COVID laboratory services. 2 of the deals last week were COVID laboratory, or this week were COVID laboratory. So that's happening. And then the big one with 35 to 70 million here of COVID challenge study tests to test those vaccines. That is materializing. And I think, people are wondering, come on, Carl, announce more deals, do more deals. All they say, bear with us for a couple of months. Our company is utterly unrecognizable where it was since it was the end of January. In 4 months, judges in 4 months and crims. Watch what we do in the next 4 months. I think will be utterly transformed, all for the positive side. A big part of this, we took a huge risk the 9th of March. Some of the former management team gave me a lot of hard time saying we shouldn't do it. But we said we'd launch the world's first coronavirus challenge study model. It got picked up by over 200 media companies around the world. 185 TV stations, radio stations mentioned it. Publicity is great, but that caused a fabulous uplift in our pipeline of inquiries. So virtually every COVID-19 vaccine company, plus, more importantly, the traditional vaccines. A lot of the work we're announcing at the moment and the deals in the next couple of weeks we'll announce are for traditional vaccine development. So despite lots of action into vaccine, there is also a huge amount of money the world's waking up. They need to develop all these other vaccines that were ignored, particularly RSV, particularly influenza vaccines. There's lots of them, so it's a great space to be now the world leader in the testing of vaccines and antivirals. Say we're in touch with 12 of the leading vaccine developers. That's a pretty good boast to make, and watch that space. We'd hope to be announcing deals, not in the coming weeks, but on those in the coming months as they sign up. The media coverage resulted with 50,000 registered volunteers on our website, flucamp.com. That's where we corral and monitor and pull our volunteers together who want to engage in the trials. hVivo had very little publicity before February and March. Now RTL in Germany, Wall Street Journal, NBC News, BBC News, Sunday Times. So we've built a great presence. And again, vanity and sanity. The beauty of this is publicity has generated a lot of inquiries. So we're spending nothing to look for volunteers, and we're spending nothing to look for inbound queries. In conclusion,
we've got a massive number of questions. There's a very popular question session coming up, so that'd be brilliant if you can.
Okay, I'll wrap up literally in 2 minutes. So I'll skip the conclusion. I think I've summarized it. There's one last piece I want to take here. If you noticed, since January, our share price flatlined around 7p to the 7th of April, to the last of the original hVivo legacy shareholders sold. Once it stopped selling, it doubled and almost tripled. Now, in recent weeks, we've had the same thing. We've the last of the hVivo legacy shareholders, the Woodford stake, has been selling, and now we're flatlining around 11, 12p. We'd hope when that party, i.e. the KSA stake, stops selling, and we're nearly there, we'd expect a share price correction. Last piece, and this is very important, we've a bunch of non-core assets, i.e. vaccine assets. The company did raise 113. We bought it for 13. They're bundled in Prep Pharma. We have 62%. We own 100% of an influenza module. But the real jewel in the crown is a 49% stake in Immutex. We've got together with a 51% shareholder, and we're running the dual process. We'd like to sell for cash. That would be the best way to do it. And that would be sent out as a dividend to all shareholders. A competitor is Thymus in Vienna, got bought by Merck. It's a very similar company. It's based in Vienna, Austria. It was bought 5 weeks ago. Price wasn't disclosed. Merger market says between 100 and 500 million or 400 million. We believe is closer to the upper end. With dual strategy, we'll IPO it, reverse the NASDAQ vehicle at the same time, and whichever one crosses the line for us, say a pure trade sale for that Immutex. It's a universal flu vaccine. It's a universal mosquito. And the last piece, you'll see that on the first page of our appendix, you'll see it. We have a strategic plan underway, and that is going to be hopefully the first big cash back to our shareholders in the coming months. All of this presentation and lots more is on our website. So I think, Richard, you said there's some questions, so maybe I'll stop talking and allow some of the questions to come through, if that makes sense.
Right, I'll start asking you a few questions. I did lose my signal twice during your speech, so if I ask you something you've already answered, we'll just move on. So I
Sure.
apologize. Okay, so the first question is, have you any idea when Acacia might be out of the stock? And I suspect the answer might be no, but have you any thoughts?
We don't. We keep bidding them. I spoke to them last week. I rang him up. The gentleman's in New York, and he said he's all his selling done. We know he has a small amount left. It was rather unusual. The 14 stakes of all the Woodford, they give them to Bernberg, who just dumped them in the market, and Bernberg has refused to take bids. They just seem to determined to keep dripping them out. There has been a lot of stock traded, so he must be nearly gone, but he's not quite gone yet. But they should be pretty soon. That's all we're saying.
Could you reiterate your long-term objectives for the company in terms of building and selling, or building and building?
I said earlier in January, if we could get this company, get revenues of 30 million, and get 3 times revenue, get 80, 90 or 100 million would sell out. Before Acacia start dumping our shares, we had the 100 million market cap. So I don't think we're going to sell at the current market cap. What we'd like to do is, look, every company should be up for sale. Particularly this Immutex asset sitting there. So step 1, let's try and sell or monetize Immutex. And step 2, naturally, I believe this company could be worth a market cap of several hundred million within 12 months. Like another company I founded was Amrit Pharma. It listed in NASDAQ yesterday. I kept cracking the whip for the management team there saying, we're going to sell, we're going to sell. Amrit now has a market cap over 300 million. It's got 200 million in bonds. So when you pass 300 or 400 million market cap and have substantial daily liquidity, the urgency to sell goes out because now, so my plan would be absolutely, the exit is still there. The exit point has just got substantially larger. And I think if we deliver half that we feel we'll deliver in the next 4 months, the exit multiple should be substantially bigger than anything we expected from before.
Can we just spend a couple of minutes on COVID-19? Is AstraZeneca engaged in your challenge study model?
Unfortunately, we're precluded from talking about anybody, but I'd say bear with us till early September, and a lot more might be revealed then, and people might be very pleasantly surprised to who and what is in it. But the best way to look at it is that some of the big pharma companies won't bother with a challenge study. They're rushing out to try and do a phase 3. Most of them are talking to see how quick can we do a challenge study. So that's where we are. So I think we'll have, at the moment, we've way more orders potentially than we could ever supply. So we're being picky and choosy. We're trying to get between 8 and 10 million per study. And if we get 8 or 10 of them in the next 12 months, we'd be very happy.
So if I can make it a more general question, what are the key characteristics of your business that attract the larger pharma companies?
The key characteristic would be we're the only party in the world. There's two companies does challenge studies, ourselves and SGS. They're based in Switzerland. They're a $20 billion Swiss company. Basically, one of our former employees, Adrian Wildfire, left 5 years ago, went to SGS and created a competitor overnight. They did give us a hard time. It's good news is Adrian's back. We hired him back. So, and the part of the reason that he and the team is coming back is SGS, being a 20 billion company, really doesn't want to be messing around with COVID-19. Look, it's risky what we're doing, but it's exciting. We can help humanity. We can advance COVID-19 vaccines by years to the market, bring them forward quickly. And more importantly, if we're getting 10 million per study and we do 8 or 10 of them, it's going to be hugely profitable for them. So it's nice to be doing something really good, but also very profitable. So we have no competitors for what we're doing, which is rather unusual.
Okay, I'm going to ask you a slightly more detailed question. Could you outline the milestones required to develop a COVID-19 challenge model and provide an update on what stage you're at and a projected completion date? And given this challenge model is a prerequisite for significant sales revenue, could you outline any risks preventing completion? So that's more detail.
Yeah, look, very simple. A challenge model is you've got to get a version of the virus working that you can control and apply. So that's called getting the characterization study. We're underway. We've got to get MHRA approval. We've got to get ethics approval. And then we've got to make sure it's safe. So all we can say is that, and on average, it takes 2 years to do this. We're trying to do it in 6 months. We started it formally 6-8 weeks ago. So it takes 6-8 weeks ago and add another 4 months. However, the beauty of what we're doing, we can get a very large upfront. All our challenge studies, we get 20-30% in cash. So once we're ready to take orders, we'll be announcing them, and they'll be quite large upfront. Some of the upfront cash amounts will be substantially bigger than deals we ever signed before. So the plan would be those trials will be starting around the year end, but they happen to go quite quickly, 1 month, and we can run a number of them together at the same time.
Okay, should we move away from that and on to another topic? So Immutex,
Yeah.
what's happening? Is the research team intact? Is it dormant? Is it waiting sale? Is it waiting to go on a NASDAQ listing? What's happening?
Okay.
And there's several questions of that sort around that particular topic.
Okay, Richard, I think page 20 that's still up on our screen there, hopefully, covers that. We're monetizing the non-core vaccine product portfolio, mainly Immutex. We're seeing strategic plans underway, and subject to agreement with the SEEK Group, it'll allow a sale for cash, and that has to, look, beauty is, it's got some cash, we're spending no more money in it. The time, if we can sell a vaccine, a universal influenza vaccine company and a universal mosquito vaccine company, I would have an Irish saying, if you can't do that, you couldn't sell life belts in the sinking ship. So I think, I'm not saying it's a sinking, I'm just saying that it won't be that hard to monetize Immutex. Some of these companies, I'm still blown away about how much we can do in 4 months. And sometimes previous management teams did less in years. But yeah, Immutex is definitely top priority as we speak. And as part of that, we will dual strategy. You can't go around saying you're for sale, and you might frighten off buyers. So you have to have a plan B. And the plan B is we're also looking at reversing into a NASDAQ listed SPAC as a special purpose vehicle with cash, because we think that could get a very high valuation. So we'll run the dual strategy over the next couple of months. As we get into the autumn, whichever one is the highest, best price for shareholders. If it gets IPO'd via the SPAC, we'll do a dividend species to all open orphan shareholders, myself included. So that means later this year, open orphan shareholders will hold a share in open orphan and equally a share in the Immutex listed vehicle. But ultimately, a nice simple trade sale, cash in the bank, which we dividend out to everybody, would be the simplest route.
There's a lot of questions on Prep Bio as well, but did I miss that when I was trying to reconnect? Did you talk about it?
Yeah, I didn't say too much. Prep Bio, we own 62%. Likewise, if we're doing the SPAC, we'll roll that in, or we might have an option of putting that into another separate vehicle as well.
And you might have covered this already, but your acquisition policy at the moment is
done. Done.
You're not doing any more for the time.
No, we acquired 2 companies. Then, being straight, was reasonably hard work. hViva was the best deal I'll ever do. I'm 56. I started working at 16. This is well over my, this is my 40th year working, but this is absolutely, acquiring hViva has to be the luckiest deal of my life. It just keeps on giving. The amount, well, no, mind you, the previous shareholders did invest 113 million sterling in the business the previous 5 years. We bought it for 13. It came with 2 million cash. So look, but it keeps on giving. We have to be careful. We just want to steadily now start monetizing parts of it, growing the share price, making sure it's profitable, and making sure it remains the world leader in the vaccine trials and testing.
Okay, well, I've summarized as best I can most of the questions, and we are actually right on the nail for time. So thank you very much indeed. It's been tremendous talking to you. I'm just going to hand it back to Keith.